There is a fund sitting in your brokerage account right now that is paying you a double-digit yield every single month. And a meaningful chunk of that payment might just be your own money coming back to you in a different envelope. I know that sounds almost too cynical to be true, but stay with me, because by the end of this video, you're going to be able to look at your covered call ETF, run one quick comparison, and know in under 5 minutes whether that income stream is actually building your retirement or quietly draining it. And the number I'm going to show you, the gap between what $50,000 in one of these funds actually returned versus what that same money did in a plain index fund over 10 years. That number genuinely surprised me when I pulled it. So here's what we're covering. We're going to look at how these funds actually work under the hood, not the marketing version. Then we're going to walk through real before and after performance data through a market correction, because that's where the strategy either proves itself or falls apart. And then I'm going to show you a version of this same income approach that actually kept pace with the S&P 500, because the goal here isn't to talk you out of income investing, it's to make sure the income you're collecting is real. Covered call ETFs have absolutely exploded over the last few years. JEPI and JEPQ combined now hold over $83 billion in assets. That is more than twice the GDP of Vermont, sitting in a strategy that most of the people holding it couldn't explain in one sentence if you asked them. And that's not a knock. It's just the reality of how these funds get sold. The pitch is simple. Own stocks, collect a fat monthly payment, sleep well. And for a lot of people watching this who are in their late 40s or early 50s and need their money to start working harder right now, that pitch is genuinely appealing. I get it completely. But here's the thing that the fund brochure doesn't walk you through. A covered call ETF works by owning a basket of stocks and then selling someone else the right to buy those stocks at a fixed price in the future. The premium they collect for selling that right is what gets paid out to you as income. Simple enough. The cost of that arrangement is that if the stocks in the fund surge, like they did in 2023 and 2024, the fund can't benefit above that fixed price. The upside is capped. The fund took the full punch on the way down, but it can only recover at a fraction of the market's pace on the way back up. That asymmetry is the whole ball game, and it's what most YouTube content about these funds glosses right over. Let me give you a real example with actual numbers because this is where it gets concrete. Take QYLD, which is one of the oldest and most popular covered call ETFs out there. It owns a NASDAQ 100 basket and sells at-the-money calls every month, which maximizes the premium income, but also caps almost all of the upside. When QYLD launched, the share price was $25. Today, it's sitting around $18. That's a 28% decline in the share price over 12 years while the fund was paying you every single month. So part of what looked like income was actually just your own capital being handed back to you in smaller pieces while the NAV quietly drifted lower. And here's where the math gets genuinely uncomfortable. If you put $50,000 into QYLD 10 years ago and reinvested every single distribution, your total return would be roughly $114,600 today. That sounds decent until you see what that same $50,000 did in SPYI over the same period, which is $196,500. That's an $81,900 gap on a $50,000 starting investment, even after giving QYLD full credit for every distribution. For someone at 50 trying to close a retirement gap, that difference isn't a rounding error. That's years of catching up, gone. Now some of you are going to say, okay, but I'm not trying to maximize total return. I need the income now. And that's a completely fair position. But here's what you also need to know about that income, because this part is where it gets weird. The monthly payment you're getting from these funds isn't always classified as a dividend in the legal sense, and the tax treatment can flip on you without warning. In 2021, QYLD was sending out monthly notices estimating that distributions were roughly 98 to 100% return of capital, meaning no current year tax owed, just a reduction in your cost basis. Investors were spending those distributions thinking they had no tax bill coming. Then the 1099s arrived in early 2022, and the entire year's distributions were reclassified as ordinary income. If you were in the 22% tax bracket and held $50,000 in QYLD through all of 2021, you collected about $6,000 in distributions and spent them, and then got an unexpected $1,320 tax bill you weren't holding cash for. That's not a fringe scenario. That happened to real people holding real accounts. And that's important, but if you don't also understand what happens to these funds during a crash, you're only seeing half the picture. In the April 2025 sell-off, JEPQ dropped almost as hard as QQQ, the straight NASDAQ index fund, because the sell-off happened so fast that the call premiums provided almost no meaningful cushion. This is the part that trips people up. These funds are marketed with a lower risk framing, and they do have lower volatility in calm markets. But in a real fast-moving downturn, the option premium is a thin buffer, not genuine protection. You take nearly the full punch on the way down, then the covered calls cap your recovery on the way back up. JEPI, for example, only captured 47% of the S&P 500's upside in 2025, while still experiencing equity-level downside during the correction. So you're not getting a smoother version of the market's returns. You're getting the bad parts at full size and the good parts at half size. And on top of that, the income itself has been shrinking. QYLD's monthly distribution peaked at about $0.198 per share in 2021. It's now around $0.169. That's a 15% income cut in dollar terms. On a $100,000 position, that works out to $936 a month today versus $1,098 a month at the peak. A $162 monthly cut that nobody announced. The reason it happened is that the fund's income is directly tied to how much fear is priced into the options market. When volatility drops, premiums drop, and your monthly payment drops with it. You have no control over that whatsoever. So let's be honest about what we're looking at here. QYLD's 5-year total return is negative in price terms. An investor who put $100,000 in at the 2021 peak reinvested every distribution and paid ordinary income tax on all of it along the way. That investor has a smaller portfolio today than when they started. The fund still markets itself on a double-digit yield. The yield looks high in percentage terms partly because the denominator, the share price, keeps shrinking. A falling NAV makes the yield percentage look better even as the actual dollar payout gets smaller. That's the part that doesn't show up in the headline number. Now here's where I want to give you something useful rather than just leaving you with a pile of problems. If you are drawn to covered call ETFs because you want monthly income and you want to stay invested in equities, that instinct isn't wrong. The Dividend investor identity is a genuinely good framework for staying motivated and tracking progress, and I'm not here to talk you out of it. But there is a structurally different version of this strategy that most people in this space have never heard of, and it solves the two biggest problems we just talked about, the capped recovery and the ugly tax treatment. It's called SPYI, and it works differently from QYLD or JEPI. Instead of selling straightforward covered calls on individual stocks, SPYI uses what are called Section 1256 index options. The tax code treats these options as 60% long-term capital gains and 40% short-term, regardless of how long you held them. That alone is a meaningful advantage over QYLD's ordinary income treatment. But the performance difference is what really stands out. SPYI's 3-year annualized total return is 17.04% compared to JEPY's 9.11% over the same period. And in 2025, SPYI captured 98% of the S&P 500's upside while still delivering monthly distributions, compared to JEPI's 47% upside capture. It's not a perfect fund and it's not a guarantee, but it's a version of this same income-generating concept that doesn't force you to choose between collecting income and participating in the market's recovery. I want to be clear. This isn't a recommendation to go buy SPYI tomorrow. What I'm saying is that if you're currently holding QYLD, JEPI, or a similar fund, and you haven't looked at the total return comparison recently, that's the first thing to do. Pull up your fund, find the total return chart, not just the yield, and compare it to SPY over the same period. Then look at what percentage of your distributions have been classified as return of capital versus ordinary income over the last 2 years. That'll tell you pretty quickly whether this position is doing what you think it's doing. If you want to go deeper on how to build a real income-generating portfolio that holds up through corrections, not just in calm markets, I've got a video on exactly that linked right here. It walks through the actual allocation framework, not just the fund names. And if you found this one useful, subscribing makes sense because this is the kind of content we put out regularly. Real numbers, real comparisons, no fluff. Before you go, I want to know, are you currently holding a covered call ETF? And did any of this change how you're thinking about it? Drop it in the comments, specifically what you're holding and what you were expecting from it. I read every single one and I'll reply. The people who leave specific numbers always get the most useful responses, and honestly, those comments help everyone else in this community figure out where they actually stand. Here's what we covered today. Covered call ETFs generate income by capping your upside, and in a real crash, that cap doesn't protect you, it just slows your recovery. Part of the monthly payment you're receiving may be your own capital coming back. The tax treatment can flip without warning and leave you with a bill you weren't expecting. And the total return gap over a decade, $81,900 on a $50,000 investment, is the real cost of chasing yield without checking the full picture. You came into this video thinking those monthly payments were income. Some of them are, some of them aren't. Now you know how to tell the difference.